Hi everyone. So welcome to the live stream today. Very much excited for having you in a new week as we continue with our discussion towards the ICA April 2022 examination. And this week we're going to be focusing on some of the critical issues that we need to understand in financial reporting and corporate reporting. And today we are starting with that discussion with one of the critical accounting standards, that is IFRS 9 financial instruments, and dealing with everything that we need to know about financial instruments. We're going to be looking at the recognition of financial instruments, the measurement of financial instruments, the accounting for financial assets, the accounting for financial liabilities, dealing with issues about compound financial instruments, or what we call hybrid financial instruments, to see how the various treatments are done in these financial instruments. So welcome to the live stream. Give me a thumbs up on the video when you join. It helps us a lot to reach students, to reach colleagues just like you, so we can together assist a lot of people. But most importantly, let me know in the comment section, how was your vast day? I hope that you had fun and really spent some time doing something for yourself and loving yourself, most importantly in that case. Give me a thumbs up on the video, comment in the chat box, let me know where are you watching us from. Any questions you have, please put it in the chat for me. I want to hear from you guys as we start this brand new week and continuing with our discussion. Remember, we are in the 7th week in our discussion towards the ICA examination. 7. So we have 5 to go. 5. Can you imagine that? 5 more weeks to go. And I believe that is going to be a great period or a great time as we continue with our discussion. So let me share my screen with you. Let's get excited about it. I see some of you joining us on Facebook, some of you joining us on YouTube. Give us a thumbs up, share the video. Let's reach many students watching the live stream today. Remember that you can listen to the audio lectures on various podcast streaming platforms. Just search for Nhyira Premium and you're going to find us there. You can also download our mobile application, the Nhyira Premium application, on the App Store or the Google Play Store. Get access to exclusive content and videos so you can prepare well also for your examination. So let's get excited and let's begin the discussion for the day in relation to IFRS 9 financial instrument. Oh, I wanted to do 19. IFRS 9 financial instrument. IFRS 9 financial instrument. Now, this is one of the most interesting accounting standards. Some students feel it is difficult. Other students feel, oh, it's not difficult, it's an easy accounting standard. Others feel that, oh, it's a standard that is just there to make it challenging for us to understand. But I believe that it is one of the most simplest accounting standards that we need to understand when it comes to dealing with IFRS 9 or financial instruments in general. Please note that if you are doing financial reporting, either we're going to have a dedicated question on this standard, or it will be part of the footnotes to the financial statement that you are going to be preparing. So whatever financial statement that the examiner wants you to prepare, whether you are going to be dealing with the statement of profit or loss and other comprehensive income, or the statement of financial position, or you are dealing with a cash flow statement, whatever financial statement that the examiner wants you to prepare, there is going to be financial instruments some way, somehow there that you need to know about, and you need to know how to deal with it in that case. Then for those of you doing corporate reporting, also the same thing, we can have it as a dedicated question there for us, either in question 5, where the examiner is going to be asking us theory questions on the standards, or we're going to be having it in the question 2, a dedicated standard question on it, or better still, it will be included in the footnotes to the preparation of the consolidated financial statement in corporate reporting. So depending on wherever you are standing at, some way, somehow, the examiner is going to figure out and find you to bring you all this or this exclusive standard to let you know or to ask you how you can treat the standard in that particular case. So financial reporting student, it's going to be there for you either as a dedicated question or in the footnote to the single entity financial statement. Corporate reporting student is going to be there for you as either a footnote to the consolidated financial statement or as a dedicated question. Wherever you are at, the most important thing that you need to understand is that you need to know how to deal with this particular issues in that case. Now, I see some comments coming in. I see some questions coming in. Please put in the chat box for me. Let me put in the chat box if you're on Facebook. Put it in the no chat box if you're on YouTube, rather, and then comment section if you're on Facebook, and then I'm going to take all your questions for you. Some questions coming in. Emmanuel Annan said, hello, Nhyira, please take your time to explain the amortization of financial assets and financial liabilities. It's quite confusing. Don't worry, Emmanuel, I got you covered, and we're going to be looking at that very well. Then Raymond Adonko said, yes, amortization is confusing. Don't worry, I'm going to make it very slim for you, very smooth, very sleek for you to understand. Definitely. Isaac Ofori and Frank Pepra watching in the office. Oh, okay. Frank and Isaac, thanks for joining us from the office. And let's get excited about it. So let's go into it real quick in that particular case. Now, when it comes to dealing with financial instruments as a whole, there are a couple of accounting standards that actually brings all of those discussions together. So let me open a slide to bring you up to speed real quick with that. Then we can, once we get that out of the way, I can begin to spread my wings and fly. So there are a number of accounting standards that are covered when it comes to dealing with financial instruments. Okay, so we have what is called the IAS 32, we have the IFRS 7. In that particular case, these are all standards that relates to various aspects. The 32 has to do with the presentation of financial instruments usually, and then IFRS 7 has to do with the issue about financial instrument disclosure in that particular case, and then IFRS 9 is for the recognition and measurement. I hope you are getting the idea. So technically, this is what we are trying to say. We are saying that we're going to look at the issue about IFRS 9. That talks about financial instruments, yes, but the focus there, it's about the recognition and measurement, how we recognize it and how we measure it. Okay, then we're going to look at IFRS 7, and that is going to be looking at the issue about the disclosure, still financial instrument, but then disclosure requirements. So the various things that we need to disclose of. Then IAS 32, also financial instrument, but it has to do with presentation. Okay, so these are the three broad standards that covers the issue about dealing with the financial instrument. So the IFRS 9 is about how we recognize, how we measure. IFRS 7 is about how we disclose, or there's disclosure requirement that has to be done in the footnote to the financial statement. And then IAS 32 has to do with the issue about the presentation of the items in the financial statement. Okay, so these are the three broad accounting standards that we need to look at, that we need to get ourselves into. Now, so the big question we then ask ourselves is, what is financial instrument? And then what are the various things that we need to understand when it comes to dealing with financial instruments? In a simple language, we say that financial instrument is simply an instrument that creates equity or liability on one end, and then assets on the other end. So any transaction that creates equity or liability on one end and creates assets on the other end can be referred to as financial instruments. Now, so what does that mean then? It means that when it comes to financial instruments, it can broadly be categorized into two. So when it comes to financial instruments, we can broadly categorize financial instruments into two. It is either the financial instrument is an equity instrument or a liability, or the financial instrument is an asset. Stay with me carefully, because this is where the journey becomes interesting, because I'm going to just cut you straight up into it and for you to know how exactly we go about it. So we have what we call equity instrument, we have what we call liability, and then we have what we call asset. So if there is a transaction, how do we know this is an equity instrument? How do we know this is an liability? How are we able to know that? Again, let me say this, that there are words that the examiner is going to be using, and that provides us with the guidelines on exactly what it is that we need to do in that particular case. So if we hear something like the entity has issued, when we hear something like the entity issued or sold, if the entity in the question is the one issuing the financial instrument or selling the financial instrument, then that means we are likely to have either an equity instrument coming in or a liability or a financial liability. Please stay with me carefully, because this is where this is the bedrock. At the end of the day, this is what it means generally. Are you getting me? This is what it means generally. So in the question, when we read the question and the examiner says the entity issued shares, the entity issued a loan note, the entity issued something or sold something, it could mean that it is a financial liability or it's an equity instrument. Now remember, if you miss that, then forget about everything else. You're going to screw it up. Are you getting me? So if you miss this one, you're going to screw up everything else going forward. So the first question you need to ask yourself is the entity issuing the financial instrument, or the second one, the entity bought or purchased the financial instrument, or if you want, acquired the financial instrument. So you have to ask yourself, if the entity is purchasing, the entity is buying, the entity is acquiring the financial instrument, then all of the records, that is going to be a financial liability. Sorry, a financial asset. Sounds good? So that is the starting point I want you to have. That as you go into any financial management question, the first thing you need to ask yourself is, what is going on in the question? The company whose financial statement I am asked to prepare, the accounts I am asked to prepare, is the entity issuing or buying? Is the entity selling or purchasing? Is the entity the one issuing the things to the public, or the entity is the one buying it? If the entity is issuing or selling, then we can have either an equity instrument or a financial liability. If the entity is buying, purchasing, acquiring, receiving, whatever it is, that is going to be a financial asset. Does that make sense? So this is the foundation. This is the foundation number one. There are two key foundations about financial instruments. This is the first foundation. The entity, is it selling or buying? The entity, is it issuing or acquiring? Then the second principle that we need to understand, even before we get into any of these financial instruments, is to ask ourselves the big question. Is to ask ourselves the big question. What is the big question? The big question. The big question we ask ourselves is, hey, when can an entity recognize a financial instrument as an equity or as a liability? That's the big question. And that is the second fundamental principle you need to understand. When can an entity recognize financial instruments as liability or equity? That's the key question. That's the key question. The way we answer this golden rule question is to ask ourselves another question. So, for instance, what is happening here is that the entity has maybe issued a loan note. Remember, this question comes in when we are dealing with issuing, okay? Because it is issuing that we may be having equity instrument or financial liability. Okay, so we are dealing with issue in here. Okay, we are dealing with issue in here. So if we are dealing with issue in here, then we need to ask ourselves, the financial instrument that has been issued by the entity, can they recognize it as an equity instrument or as a liability? Now, to answer that golden question, we need to also ask ourselves another question. Are we following? We need to ask ourselves another question. So, what is the other question we ask? To answer the golden rule question, we need to ask ourselves, does the entity have an obligation to redeem or repay the financial instrument? Does the entity have an obligation to redeem or repay, to redeem or repay the financial instrument? Are you following? That's a golden rule question. So we are asking, when can we treat it as equity? When can we treat it as liability? Before we can answer that question, we need to ask ourselves another question. Does the entity have an obligation? Is the entity bound to repay it? Is the entity bound to redeem it? Two answers can pop up in that regard. Two answers. Two answers. Yes, the entity has an obligation to redeem. No, the entity has no obligation to redeem. Oh, so two answers can pop up. If yes, the entity has an obligation to redeem, then we will recognize the financial instrument as a financial liability. So if yes, recognize the financial instrument that has been issued by the entity as a financial liability. Are you getting the picture? If the answer is no, we have no obligation to repay, we have no obligation to redeem, we have no obligation to give anything to anybody, then what is going to happen is that the financial instrument is recognized as an equity instrument. As a financial, as an equity instrument. That's it. That is it. Any questions, please? I see some of you guys joining. You are welcome. This is our discussion on financial instrument. As we build on it, it's one of the fundamental accounting standards that would definitely 99.9% of the time be in the exam hall. If you are getting some values, please give us a thumbs up on the video. Subscribe to the channel in case you've not subscribed. But most importantly, if you have any questions, put them in the comment section for me, and I'll answer all your questions for you. I'm populating your questions here. I'm seeing them. And so I'm going to be answering all your questions. So put it in the chat for me and then share the video. Let us reach many students watching this most important topic that is going to definitely be in the exam hall one way or the other, whether we are doing corporate reporting or financial reporting, right? So give us a thumbs up on the video and also share the video. Let's reach many students just like you. So these are the two fundamental principles we need to understand when it comes to dealing with financial instruments. Like I said, if you screw these two principles up, bye-bye. We will give you bye-bye. We will waive you bye-bye. Then that is all, because there's nothing we can do for you again. So number one, anytime you are reading questions that relates to financial instruments, you have to identify, is the entity issuing or selling? If the entity is issuing or selling, that means in your mind, you must know there could be either equity instrument or financial liability. If the entity is issuing and there could be equity instrument and financial liability, then the next question you need to ask yourself is, how should the entity recognize it? The entity should recognize it as an equity instrument or financial liability, depending on whether the entity has an obligation to repay. If the entity has an obligation to repay, what have we said? We said that you should then recognize it as a financial liability because the entity has an obligation to repay. But if not, it should be recognized as an equity instrument. Sounds good? Should be recognized as an equity instrument. That's the deal. That's the deal. If you miss these two scenarios, I'm sorry for you. Then the last part is if the entity is buying, the entity is acquiring, the entity is the one purchasing, the entity is the one receiving, ultimately, we have to recognize it as a financial asset. No long talk. We just go straight up with it. Okay. So then the question we ask ourselves is, Nhyira, what are some of the examples of equity instruments? What are some of the examples of financial liability? What are some of the examples of financial assets? So let's look at some scenarios and how they are recognized really quick. Some scenarios and how they are recognized. So I'm going to present you with my slide on that. So I have a table here covering some scenarios and their recognition. I want you to stay with me carefully. Now, please note that the material that I'm using on this live stream is from our new financial reporting and corporate reporting book. So that is the source document for my lectures here, and the way it is presented, that is how we present some of these things in these books. So stay with me carefully as we walk through this table. Number one, issue of shares. When an entity issues shares, like MTN issues shares, or whoever issues shares, the entity does not have an obligation to buy back the shares. The entity does not have an obligation to do anything on the shares. So if the entity issues equity shares, okay, equity shares, definitely what is going to be happening is that the entity issuing will recognize what? It's as part of stated capital. So it will be equity in that case. Now, once it is equity, it means the entity has no obligation to what? Repurchase the shares. You, the one buying or purchasing, the entity that is buying the shares will recognize that as a financial asset in the name of equity instrument under non-current assets. Okay, and we're going to expand on that in a moment. But that is the first thing. So when an entity issues equity shares, the issuing entity recognizes that as part of what? Stated capital. Okay, as part of stated capital. Then the entity buying the shares will recognize that as a financial asset in the name of equity investment. Are you getting it? That is the first point. Two, sale of goods with repurchase option. Stay with me carefully because this is a trap scenario that can be in the footnote for you, especially for financial reporting students. So it is where the entity has sold some goods, but then they have an arrangement with the buyer of the goods that they will buy back the goods sometime in the future. Now, what is happening there is that is a financial arrangement. Okay, and the goods are being used, the inventories are being used as a collateral facility. So in such scenarios, what is happening is that the entity selling the goods will be recognizing financial liability. Then the entity, what it means is that the entity is using the inventory as what? A collateral facility. So this is a loan. So the entity will recognize a loan being the fair value of the amounts received from the person, and then it will be recognized in accordance with IFRS 9 financial liability. And we'll get into that in a moment. What does that mean? It means included in the closing stock at the end of the year for the entity selling, these inventories will be part of their closing stock. Are you following me carefully? So it means it is not a sale. So we will subtract the sales value from sales, subtract the cost of the inventory from cost of sales, and include it in the inventories as part of the closing inventories. That is very, very important. That is very, very important. So transactions of that nature is not a sale, but a financial arrangement. So if it is a financial arrangement and not a sale, the transaction is reversed. It's reversed. Now, when we say the transaction is reversed, what exactly are we saying? We say that deduct it from sales, the sales value, deduct it from cost of sales because you've not sold anything. But most importantly, include the inventories sold. And I'm going to put sold in quotes because really we've not sold it. Okay. It is just being used as a collateral facility. So the inventory sold, include inventory sold as part of closing inventory. Sounds good? That is the idea. That is that scenario there. So sale of goods with repurchase option. Sale of goods with repurchase option. Sale of goods with repurchase option. It is not a sale, it's a financial arrangement. So we reverse the transaction, deduct the selling price from sales, deduct the cost of the inventory from cost of sales, then include in the closing inventory the inventory that has been purported to have been sold by the entity. By the entity. Then the entity buying these goods, remember, it's not sold, right? But the entity that is seen as the one buying these goods on the sale or purchase returns, sales with purchase returns, with purchase option, will be recognizing a financial asset. Okay, so for you at the receiving end, for you the one buying, there is no cause for alarm. You just recognize financial asset and you go away. In that case, financial asset, because you lent money to somebody, so it's a financial asset. Are you getting it? It's a financial asset. You've lent money to somebody. Next one, issue of loan notes. If there are any questions, please put it in the comment section for me on YouTube, on Facebook rather. Then you put it in the chat for me. For those of you who are on Facebook, if there are any questions, please put it in the chat for me. Let me know. So issue of loan notes. Issue of loan notes. Now, when it comes to issue of loan notes is loan notes. It means the entity has an obligation to what? Repay. So because the entity has an obligation to repay, we will recognize it as what? A financial liability. Because the entity has an obligation to repay, we recognize it as a financial liability. But you, the entity buying the loan notes, the entity that is buying the loan notes, acquiring the loan notes, purchasing the loan notes, will still be recognizing financial asset. So you realize that the deal is the one with the one selling. The deal is with the one issuing. The deal is with the one who is selling the goods. Next one, issue of convertible loan notes. Now you got to be careful here. This is where we get into the compound financial instrument, and we'll look at this later on. Compound financial instrument, or what we usually call hybrid financial instrument. Anytime an entity issues a convertible loan note, stay with me carefully. Anytime an entity issues a convertible loan note, the issuing entity must recognize two things. Because as per IFRS 9, convertible loan notes has two features. We have to recognize both financial liability and recognize equity instruments. And we're going to get into that in a moment. But anytime you hear a question that the entity has issued convertible loan notes, note that we must recognize both equity instruments and then financial liability. Please note, the entity that is buying the financial instrument, dear, he will definitely recognize financial assets. So the entity buying, purchasing, acquiring the convertible loan notes, we don't split for them. So if it says the entity purchased convertible loan notes, even though you are hearing convertible loan notes, we still recognize it as what? A financial liability. What have we done? We've bought debt instrument. So they recognize this as a financial liability, and that's a debt instrument that they've bought. It's a financial liability, but it's a debt instrument they've bought. Sorry, it's a financial asset. Sorry, it's a financial asset, but it is a debt instrument that they have bought. And we'll get into all these in a moment. Stay with me carefully. Stay with me carefully. So that is the financial or issue of convertible loan notes. The entity issuing will recognize both financial liability and equity instrument, but the entity buying the convertible loan notes will still recognize financial asset as a debt instrument. The reason I'm emphasizing on debt instrument is because of the subsequent measurement of this, and we will get into that and you will get a understanding in a moment. Then the final one in my table is sale and leaseback. This is an interesting area, and you will understand this much better later on in IFRS 16 leases. Now, again, one of the ways that an entity can raise finance, aside this sale of goods with repurchase option, is to do a sale and leaseback transaction. Now, when a sale and leaseback transaction is undertaken and performance obligation is not satisfied as per IFRS 16 and IFRS 15, then the sale and leaseback is seen as a financial arrangement. So if it is seen as a financial arrangement, we have to recognize a financial liability. We have to recognize a financial liability. We have to recognize a financial liability. Like I said, you will understand this pretty well later on when we are looking at IFRS 16 leases. When we are looking at IFRS 16 leases. So the entity that is selling its building and leasing the building back, because performance obligation is not satisfied, because there has not been transfer of risks and rewards in the asset to the supposed lessor or buyer, we would say it is a financial arrangement. So we would just recognize financial liability and continue to depreciate our asset or account for the asset as per IAS 16, as per IAS 40, or as per whatever treatment we deem it fit for that asset. But the supposed buyer, the supposed lessor in that case, will still just be recognizing financial asset as again a debt instrument because they have borrowed or lent money to the entity. These are some scenarios and how we recognize them in the financial statement of the seller, the issuer, and in the financial statement of the buyer and the purchaser. Does that make sense? Any questions, please? Let me know. Any questions? Put it in the comment section for me if there are any questions. Put it in the comment section. Give us a thumbs up on the video if you're getting some values already. It helps us a lot, makes the video more engaging, and YouTube and Facebook will be able to push the video so we can reach many people. So smash the thumbs up button. It helps us a lot. And also share the video. Let's get many people coming up on the live stream. So seeing some comments here, let's see if I can take some real quick before we continue. Johnson Tete said, hello, Nhyira, please. I'm preparing for the ICA for August. What is some of the books I need as starting afresh? I don't know what subjects you are writing in August. So probably if you provide me with a subject you are writing, then I can give you some guidelines in that case. Then Emmanuel Annan said, please make a video on advanced consolidations such as step acquisitions. Okay. So step acquisitions and consolidation. All right. That is advanced financial reporting or corporate reporting. We'll look at that. Bright IET, it's giving us too sure for the chatting. So thank you, Bright. Isaac Ofori said, great delivery. Thank you, Isaac. Thanks very much. Okay. So now that we have seen how we account for financial assets, we've gone through the scenarios. Let's pick the three items one after the other and share some thoughts on them. Let's begin the journey with financial assets. So this is where the journey is going to begin. But remember, all these foundations are very critical. And like I said, if you screw up the foundations, you screw up everything in that particular case. Wahid said, I joined so late today. Well done, Master. Always a pleasure. Okay, don't worry. You can watch the beginning part after the live stream. So let's look at financial assets. Okay. So if we are looking at financial assets, it means the entity is the one what? Buying. So because if you're in financial asset, it means the entity is buying or acquiring or purchasing. Sounds good? Because I want you to have that at the back of your mind. I want it to become solidify in your brains that the time I can recognize, because this is some of the things that students keep on asking me. Nhyira, this item, should I recognize it as a financial asset or as a financial liability? Immediately you ask me that question, it means you don't understand the basis, the foundations of financial instruments. So if the entity is the one buying, the entity is the one purchasing, the entity is the one acquiring, we recognize a financial asset. Okay. So how do we recognize financial assets? How do we do that? How do we do that? Now, there are two broad approaches that we can know about when it comes to dealing with financial assets. Two broad approaches for its recognition. So it could be recognized or carried at fair value through profit or loss. So we have what I call the default treatment. So the default treatment, and then the alternative treatment. The default treatment and the alternative treatment. So stay with me. The default treatment is where we carry the financial instrument at fair value through profit or loss. Carried at fair value through profit or loss. Okay? That is the first treatment. That is the default treatment. Now, you know fair value already, because fair value is simply the value at which an asset can be sold or a liability settled in an arm's length transaction. But when we talk about fair value here, we mean the value at which you bought the shares. Okay, the value at which you bought the shares or the money you gave to the person, if it is a loan, at the end of the day. So that becomes the fair value. And we're going to expand on this a little bit as we solve some questions. So the default treatment is to carry the financial asset at fair value through P&L. But what are the reasons why we will carry financial instruments through P&L like this? What are the reasons in that particular case? Three reasons usually that we can talk about. Number one is, for instance, if it is for trading purposes. Okay, so if the financial instrument is for trading purposes, so financial instrument is acquired is for trading purposes. Meaning that maybe the entity just bought it to sell it to make some gains at the end of the day. Like, for instance, insider dealing, which is illegal though, but maybe the entity has some connection in the company, and then somebody comes to tell them that, hey, our company is about to announce something big and it will increase the value or the share price of the company. So you have to quickly get in and then buy some shares. Then we go and buy some shares in that case. So if you buy the shares, your objective is after they make the announcement and the share price goes up, you go and you will sell it. Now, that is illegal. Insider dealing is illegal. Let me say that though. But then I'm saying that if the entity buys the financial instrument or acquire the financial instrument with the intent of selling it within the shortest possible time, then we say it is for what? Trading purposes. For that reason, they will carry it at fair value through profit or loss. They will carry out fair value through profit or loss. Then Number two, maybe they bought it as part of their short-term strategy. So it is acquired as part of short-term strategy of the company, as part of short-term strategy of the company. So for instance, the entity has some surplus cash in the short term, and they are looking for some investment to put that money in. But then they are not seeing any investment, then boom, they go and acquire some shares, that kind of thing. So within the shortest possible time, they can make some returns and then go away in that particular case. So if it is part of the short-term strategy of the entity, no problem. We go into it in that particular case. So usually, if it is for trading purposes or it's part of the short-term strategy of the entity, then we carry it at fair value through profit or loss. Now, what does that mean? If we are carrying the financial instrument at fair value through profit or loss, what is going to then happen is that any transaction cost that we incur will be recognized as expense in the P&L account. Please take note of that very well. Any transaction cost incurred, any transaction cost incurred. Oh, give me a moment. My pencil. Just wanna see what's going on here. Let me re-pick it up. Okay, I'm back. So any transaction cost incurred shall be recognized in the profit or loss. Definitely as an expense, okay? Definitely as an expense. Does that make sense? So if you are recognizing at fair value through P&L, then any transaction cost the entity incurred will be recognized where? In profit or loss as an expense. So again, let me give an example. Now, this is just for illustrative purposes. So let's say that I go and buy MTN shares, or we go and buy MTN shares. Our company goes to buy MTN shares with the intent that we will sell the shares in the next 3 months and make some gains, because we believe, based on the analysts and goals, the shares of the shares of MTN will rise. Then when we are buying shares, you need to deal with a share broker. So the brokerage firm, the commission we pay the brokerage firm becomes the transaction cost, right? What we are saying here is that since the shares we are buying is for trading purposes, we want to buy it and sell it in about 3 months later and make some gains and go away. The brokerage firm's fee, the fee we are paying to the brokerage firm will be recognized as what? Expenses in the profit or loss account for the year ended under review. That's what we're talking about. That's what we're talking about. That's what we're talking about. But there is an alternative option. There is an alternative option. The alternative option is that we will carry the issue. Now, before I go there, let me make a final statement on this one. Before I go there, okay, thank you. Trading purposes. I'm writing purchases again. Can you imagine that? Okay, thank you, Kobe K. Thank you very much. Trading purposes. Thank you very much. So, still under the fair value through profit or loss, it means that any fair value gain or loss, any fair value gain or loss shall be recognized in the profit or loss. Shall be recognized in profit or loss. That's it. That's it. So if we are acquiring the shares, acquiring the asset for trading purposes, okay, it's a short-term deal that we are arranging. In that case, transaction cost is written off in profit or loss. Then what is going to happen is that any fair value gain or loss is going to be recognized in the profit or loss. Please note that this fair value gain or loss thing will come in the picture if we are dealing with shares. If we are dealing with shares, so we bought shares in another company, or we are dealing with equity instruments. If it is a debt instrument, it is carried at amortized cost. And we're going to explain that later on. Don't worry. We're going to explain that later on. Okay? We're going to explain that later on. But then this fair value gain or loss, it's because the entity bought a share or some shares, or the entity bought equity instrument. That is the default treatment. So if the question is quiet, the examiner doesn't tell us whether the financial instrument is acquired for trading purposes or what is acquired for, the examiner is quiet, then we will go with a default approach. We'll go with a default approach. But there is an alternative treatment. There are times when entity buys shares or entity will buy loans, but they are not buying it for selling. They are not buying it to make any money in the short term, but they are buying it for the long-term gain. In that case, it is carried at fair value through OCI. So with alternative treatment, the financial asset is carried at fair value through other comprehensive income. Through other comprehensive income. That's OCI. So we have at fair value through P&L, at fair value through OCI, at fair value through P&L, at fair value through OCI. So that is the second treatment. Under that particular scenario, what is going to be happening is that any transaction cost that is going to be incurred will be included in the initial cost of the asset. Okay? So any transaction cost is recognized as part of the initial fair value of the financial asset. And I'm going to explain that to you in a moment. Of the financial asset. What does that mean? What does that mean? I'm going to explain that to you in a moment. This is what it means. So when we are looking at this whole thing in that particular case, we are going to be looking at it from the perspective of the fact that, let's say we are doing at fair value through P&L. If you are looking at it at fair value through P&L, what we are saying here is that the fair value of the shares, double entry will go this way. You debit the equity instrument. Let's say you bought shares, okay? So equity instruments will be debited. And because you are buying the shares, you're going to credit cash or bank, or maybe payables if it is outstanding at the end of the year. Because sometimes when you buy shares, it's not wired at once. Okay? So that is the fair value. Then any transaction cost that we incur, what we said is that you're going to debit profit or loss because that's an expenses with a transaction cost. And then credit cash or bank, or even if it is outstanding at the end of the year, credit payables there. So this is the default treatment at fair value through P&L, at fair value through P&L. Then the entity can go in for at fair value through OCI. At fair value through OCI. Now, the at fair value through OCI, what we are saying here is that where the entity is the one that is going to be buying, like still buying, what is going to happen is that the fair value is still debit the equity instrument, or maybe financial assets, because even though I've said equity instrument here, it's financial asset we are debiting. Because if it's a debt instrument, then we will call it debt instrument. Because financial assets can be a debt instrument or it could be an equity instrument. That's very important. Then we credit cash or bank or something else. In that case, payables, if it is outstanding for the period under review. If it is outstanding, then we deal with it like that in that particular case. Then what is going to be happening here is that once we calculate that amount, any transaction cost that is incurred, any transaction cost incurred, instead of debiting P&L, stay with me carefully, instead of debiting P&L like you did here, this one, it will be included in the initial cost usually of the financial instrument. So you're going to be debiting the financial instrument or the financial asset and still credit your cash or bank or payables. So you have to be careful here. You have to be careful here because there are times students ask, when do you subtract financial transaction cost from the financial instrument and when do you add? Please stay with me carefully. That is another commonly asked questions. When do we subtract the transaction cost? When do we add it? If the entity is the one issuing and we are dealing with financial liability, then the transaction cost is subtracted. We will deal with financial liability later, but listen carefully because this is one of the commonly asked questions. When do I subtract transaction cost? When do I add it? So in a simple language, transaction cost. When do we subtract it from the financial instrument? When do we add it to the financial instrument? We subtract it from the financial instrument if we are dealing with financial liability. If you are dealing with financial liability, meaning the entity in the question is the one issuing, okay, or selling, then we subtract. Okay, we subtract. But then if we are dealing with financial assets and the entity is carrying it at fair value through OCI, financial asset, and the entity is carrying it at fair value through OCI, fair value through OCI, then we add it. Like I said, this is one of the commonly asked questions. Nhyira, when do I subtract the transaction cost? When do I add it? This is it. This is it. Meaning the entity is the one buying. The entity is the one purchasing. The entity is the one acquiring. Because these are small things which when you mix, you're going to be punished by the examiner. You're going to be punished. Emmanuel Anand said, I think there are three broad categories instead, or I don't know the school of thoughts that you come from with the three broad categories, though. Sometimes debt instrument is handled separately, so it could be treated as three broad category, but it's actually in two broad issues in that particular case. Either you're carrying through P&L or carrying through OCI, because the debt instruments can also be carried out through P&L or through OCI in that particular case. All right. So yes, some school of thoughts deal with debt instrument as another category of financial asset, but technically the debt instruments can be carried out through P&L and through OCI, whichever be the case we go in for. That is why the two primary thing is P&L and OCI. Oxbet said, please say, what will happen if it's silent and you choose to carry it at fair value through OCI instead of fair value through P&L? Okay, maybe the examiner could overlook it for you, but usually when the examiner is quiet, it depends. It depends. And there are certain financial instruments that are not easily convertible in the short term. Are you getting it? So there are certain financial instruments that are not easily convertible in the short term. So if the financial instrument is not easily convertible in the short term into cash, then what is going to happen is that if the examiner is quiet, those financial instruments could still be carried at fair value through OCI. Do you understand it? If some debt instruments are very difficult to sell in the short term, it's going to take time before you sell them. And even there are certain times where certain company shares are very difficult to sell in the short term. Okay. And then there are other negotiable instruments or financial instruments which are very hard to get rid of in the short term. So for that reason, they could be classified as fair value through OCI in that particular case. So, Oxbert, that's the issue there. Wahid said, what is default approach if the examiner becomes silent? Like I mentioned, the default approach if the examiner is quiet is for us to go through at fair value through P&L. That's the default approach that we can talk about there. If the examiner is quiet. Emmanuel said, the third category is financial assets using amortization. Like I said, if the financial asset is a debt instrument, on subsequent measurement, we account for it using the amortization schedule. That is on subsequent measurement. But that doesn't change the fact that it will be recognized through P&L or recognized through OCI. Because there are certain debt instruments that an entity buys, and it is for long-term strategy of the company. So if it is for long-term strategy of the company, then they will not recognize it at fair value through P&L. So that is why I'm saying that, yes, there is debt instruments that companies buy, and for debt instrument on subsequent measurement, we use the amortization schedule. That is why I told you that any fair value gain or loss that I'm talking about here is about shares. It's about equity, because if we buy debt instruments, we don't do fair value gain or loss. What we do is we carry it at the amortized cost schedule. So yes, there are certain school of thought that see that as another category, but I'm not looking at that as another category, because primarily it is either fair value through P&L or fair value through OCI. But if it is a debt instrument, on subsequent measurement, you use the amortized cost schedule to account for it. If it is an equity instrument, then you don't use amortized cost. That one, you determine the fair value gain or loss on subsequent measurements, and that fair value gain or loss could be accounted for either in the P&L or in the OCI, depending on what the examiner or what the entity is looking at accounting for the item. So that is the issue there. So it's about school of thought and the kind of understanding you have relating to the way the item is supposed to be presented in the financial statements. All right. Any other questions, please? Any other questions? So that is what we mean by that particular case. Remember, like I mentioned, these are the two broad categories. Either we are doing fair value through P&L, fair value through OCI. And then the transaction cost treatment can either be in the P&L, and then can either be in the included in the initial cost of the asset. Like I said, this is the third fundamental principle. So let's put it together. The first fundamental principle I want you to take away is that, number one, is what we did in the introduction, that you must know, is the entity buying or selling? Is the entity issuing or acquiring? That's the first principle. Second principle, if the entity is issuing or the entity is selling, do you recognize it as an equity instrument or a financial liability? To answer that question, you must ask yourself, does the entity have an obligation to repay? If the entity has an obligation to repay, then what is going to be happening is that you are going to be recognizing that financial liability. You are going to recognize the financial instrument as what? A financial liability. But if the entity has no obligation to repay, then it will be recognized as what? An equity instrument. That is the second broad principle I want you to understand. The third broad principle I want you to understand is the treatment of transaction cost. Nhyira, when do we subtract the transaction cost from a financial instrument? When do we add transaction cost to financial instrument? We subtract financial transaction cost when we are dealing with financial liability. In other words, the company has issued or sold the loan notes. We add the financial instrument or include it in the initial cost of the financial asset if we are dealing in the financial instrument, if we are dealing with financial assets and it's being carried at fair value through OCI. Does that make sense? So these are three broad pillars on which we build IFRS 9, on which we build the entire financial instrument issue. Nana Kwatin said, "Sir, please, is fair value through OCI the same as through amortized cost?" No, no. This is what we're saying. We are saying that the fair value through OCI, fair value through P&L, is simply how the entity has selected to treat transaction costs and then subsequent movements. This method is based on how the entity has chosen or want to treat transaction cost and subsequent movement in the financial assets. If the entity want to write off the transaction cost, then they will use at fair value through P&L. That means any fair value gain or loss will be recognized in the P&L. The amortized cost comes in if the financial instrument we are dealing with is a debt instrument. So the entity buys loan notes. The entity lend money to someone else. If it is a debt instrument, then it will be accounted for as what? Amortized cost. It will be accounted for as amortized cost. And even that debt instrument, the entity can decide, that is on subsequent measurement. The entity can decide, do I want to deal with it at fair value through P&L or at fair value through OCI in that particular case? And that is the idea about what we are talking about. So these two broad approaches is about how the entity selects to deal with the transaction cost and the subsequent movement in the financial asset. Amortized cost comes in if we are dealing with financial asset that is a debt instrument. If it is an equity shares, we deal with fair value, gain or loss. Like I mentioned here, if it's an equity instrument, fair value gain or loss. But if it's a debt instrument, on subsequent measurement, debt instruments, you can't determine their fair value. All you do is you carry them at amortized cost. So the amortized cost treatment is the subsequent treatment for a financial asset that is a debt instrument. For a financial asset that is a debt instrument. Any questions, please? Any questions? So that is the issue about these two broad treatments. So now that we've gotten that out of the way, the next issue is to crunch some numbers and then see what exactly we need to look out for. Nana Kwatin said, well noted. Thanks for your explanation. Okay. So the next issue is to crunch some numbers. Now, remember, you can download our mobile application on the App Store or the Google Play Store. The Nhyira Premium app is the same name as you see on the channel, or for those of you watching on Facebook, on my Facebook page. So you just search for Nhyira Premium and you download the app. You get access to exclusive lecture videos, which some are not available here on YouTube and not available anywhere, but they are available in the mobile application. You get access to some notes on various topics and various subjects and some blog posts on various other issues that you need to understand. Then also you will be able to enroll in our full course in case you want to enroll in our full course. Over the weekend, we started with our executive revision masterclass for the ICA April 2022 examination. So we decided to start our executive revision masterclass earlier this semester and have 6 weeks available for us to go through various things, specific issues for students to prepare well for the examination. So over the weekend, we started with our executive revision masterclass, focusing on key areas that will assist students in order for them to pass the examination. Remember also that you can listen to the audio lectures of this stream on various podcast streaming platforms, Spotify, Apple Podcast, Pocket Cast, Radio Public, wherever you are, you just search for Nhyira Premium, and definitely I will be available there, and you'll be able to get access to the audio lectures, so you can listen to them over and over again and prepare yourself very well for the examination. Prepare yourself very well for the examination. So that is it about dealing with financial assets. Now, like I said, the next thing will be to crunch some numbers. However, because of time constraints, I'm going to be concluding around here today. And God willing, tomorrow we look at the part two, look at some questions under the financial assets, look at some questions on debt instruments. Then we'll go to financial liability and also see how financial liabilities can be treated. Remember, the three takeaways I want you to have in today's discussion are: one, is the entity issuing or acquiring? Is the entity selling or purchasing? That is the principle number one. Principle number two, I want you to take away from here is: if the entity is issuing or selling, would we recognize it as a financial asset or as a financial liability? To answer that, we ask ourselves, does the entity have an obligation to repay? If the entity has an obligation to repay and they are issuing, then we will recognize it as a financial liability. If they have no obligation, they will recognize it as an equity instrument. That's the second takeaway I want you to have. Then the third takeaway I want you to have is about treatment of transaction cost. In Shire, when do we add transaction cost? When do we subtract transaction cost? You will subtract the transaction cost if you are dealing with financial liability. The entity is issuing a debt instrument. Then the transaction cost they incur will be subtracted. But if the entity bought a financial asset, then in that case, the transaction cost may be included in the initial cost if they choose to carry it at fair value through OCI. So these are the three pillars on which we build IFRS 9: financial instruments recognition and measurement. I see some comments coming in. Let's see. Raymond said, please, how do you amortize a debt instrument? Raymond, we will talk about that tomorrow, God willing, on the live stream, because we will look at debt instrument definitely tomorrow. We will solve a question about it. Then you will see how the amortization schedule is prepared. Emmanuel Annan said, bless you, Mr. Premium. Amen. Bless you too. My name is Blessing already, so that's double blessing for me, Nhyira. Thank you very much, Emmanuel. Raymond said, thanks a lot, boss. You are too much, sir. God bless you. God bless you to Raymond, and thanks for joining me. So thanks for joining me on the live stream today. It's always a pleasure. Thank you guys for giving us a thumbs up on the video, sharing the video so we can reach many students across the country and across the continent. And for those of you who continue to share the videos, thank you very much as we build this community. My goal for creating this platform and doing this live stream is simple: to provide you with the assistance that you need, to provide you with the guidelines that you require in these specific challenging topics, so that you can go into the exam hall, write the exams, pass the exams, and most importantly, become successful. Because if you are successful and I'm successful, the world is going to be a much better place than if only just a selected few people. So that is why we do these live streams. So make sure you support us and continue to be part of the community in that case. So that's it about that. Thanks for joining me. I'll catch you same time tomorrow. The stream for tomorrow has already been scheduled, so you can just check on the uh, channel and then click the notification bell, so that when I go live, you'll be notified on YouTube. In case, for those of you watching on YouTube, you've not subscribed, I don't know why, but subscribe. Okay, subscribe. Oxbet said, please, if you say may, does that mean they have option? I don't know the context in which you are taking my mail. Are you talking about the transaction cost that I said may be may be added? Yeah, because the transaction cost will be written off in P&L if we are carrying the financial asset at profit or at fair value through P&L. Are you getting it? So if the transaction cost, the financial asset is carried at fair value through P&L, the transaction cost will be written off in the P&L. But if the financial asset is carried at fair value through OCI, then the transaction cost will be included. So that is why I use the word may, because I was making generic statements and I clarify it later on there. Emmanuel Autry said, thank you, sir. Always a pleasure. Martin Akrofi said, thank you. Always a pleasure. So that's it about that. I'll catch you same time tomorrow at 4:30 p.m. as we continue with our discussion. Remember, we have 5 weeks to go. 5. 1, 2, 3, 4. Just 5. So please make sure you raise your game. Make sure you study very hard. If you feel you are prepared to write the April exam, go for it. If you feel you are not prepared, then main to mampamrika. In other words, don't run by heart. Okay? Take it easy and maybe go in August. The most important thing is going into the exam hall and pass the exams. I'll catch you same time tomorrow. Stay safe and stay blessed. Bye-bye.